India in Numbers, an in-depth look at the social, economic, healthcare, and education sectors in India. Disclaimer: this presentation is provided for educational and informational purposes only. The data is gathered from various external sources. Their inclusion does not constitute an endorsement of the original authors, their viewpoints, or their methodologies. The contents should not be construed as a criticism, negative evaluation, or disparagement of the government, any of its departments, ministries, and agencies or officials or residents of a state. Data sources and caveats. The contents of this deck are based on data released by official agencies such as Reserve Bank of India, RBI, World Bank, WB, IMF, United Nations, Government of India including Niti Aayog, Ministry of Health and Family Welfare, and PRS Legislative Research, Government of Indian States. Each slide will show the data source. There is a vast amount of data available on the internet, from government, NGOs, private organizations, etc. This presentation looks at a small subset of this data. It is meant to provide an overview, not a comprehensive analysis of the data.
Every effort has been made to ensure the accuracy of the data presented. Any inadvertent errors or omissions are unintentional and will be corrected upon receipt of verified data from official sources. The audio has been generated using Google Text-to-Speech, TTS. The automated synthesis may result in occasional mispronunciations of specific regional names, technical terms, or Indian states. Your understanding is appreciated.
Charts. The RBI Statistics Handbook provides data for all the states and union territories. For reasons of clarity and space, most of the charts in this presentation show the top 10 states and the bottom 10 states. In some charts, the data for India as a whole and other countries are shown as a comparative metric.
The following metrics will be used to understand the economic growth of states and union territories. Gross State Domestic Product, GSDP, constant prices, Net State Domestic Product, NSDP, constant prices NSDP per capita, fiscal deficit as percent of GSDP, revenue deficit as percent of GSDP liabilities, as percent of GSDP, sectoral contribution and spending, subsidies, tax contribution and devolution, unemployment rate per capita, power availability, length of roadways and railways. We conclude with some suggestions on how these metrics can be improved, with a focus on the devolution methodology adopted by the Finance Commission.
Gross and Net State Domestic Product. The Gross State Domestic Product, GSDP, is the value of the goods and services produced by a state. GSDP can be shown in constant prices or current prices. Constant prices, real GDP, adjust for inflation by using prices from a base year. Current prices, nominal GDP, reflect the market value of goods and services at the time they were produced. Constant prices will show the growth of the economy over a period of time. If a company produced 100 cars each costing 1 lakh 5 years ago, the value would be 1 crore. If it produces 100 cars this year, each costing 1.5 lakhs, the value would be 1.5 crores. However, the company has not grown. The customer is paying more for the car due to inflation. The RBI Handbook provides data using both constant and current prices. In this summary, GSDP will be shown based on constant prices because that is the appropriate metric to analyze growth of the economy. The Net State Domestic Product, NSDP, is the GSDP minus the consumption of fixed capital, such as wear and tear and replacement of capital assets. The NSDP provides a more accurate determination of the growth of the economy. The NSDP will be lesser than the GSDP because of the consumption of fixed capital. The NSDP is used to calculate the per capita income of the people of the state. Gross State Domestic Product at constant prices. At constant prices with a base year of 2011-2012, Maharashtra, Tamil Nadu, Uttar Pradesh, Karnataka, and West Bengal were the largest contributors to India's GDP. Note, data for some states/UT are not available in the report. Net state domestic product at constant prices. At constant prices, with a base year of 2011-12, Maharashtra, Tamil Nadu, Uttar Pradesh, Karnataka, and West Bengal had the largest net state domestic product. Note, data for some states/UT such as Goa, Gujarat, and Manipur are not available in the report. The NSDP is calculated by subtracting the depreciation from the GSDP. Net per capita constant prices. At constant prices, with a base year of 2011-12, Delhi, Karnataka, Tamil Nadu, and Haryana had the highest net per capita income. Bihar, UP, Jharkhand, and Madhya Pradesh had the lowest per capita income. For 2024-25, Bihar's per capita income of 36,342 rupees was 18% that of Karnataka's at 204,605 rupees. Even though UP was the third highest contributor to India's GNP, its very large population results in a very low per capita income of 55,990 rupees. Fiscal and revenue deficit. Revenue expenditure is the day-to-day operational costs of the government. Revenue receipts is the tax and non-tax income of the government. Revenue deficit is the difference between revenue expenditure and revenue receipts. Fiscal deficit is the difference between total expenditure and the sum of the revenue receipts and non-debt capital receipts. Non-debt capital receipts includes loan recoveries and disinvestment. Revenue deficit shows an inability to fund day-to-day operations. Fiscal deficit shows a reliance on borrowing. Fiscal deficit can happen due to creation of assets such as roads, rail, ports, etc. Ideally, the government must have zero revenue deficit, but can have a fiscal deficit due to the creation of capital assets such as infrastructure. According to the Fiscal Responsibility and Budget Management Act of the Government of India, the fiscal deficit must be no more than 4.5% of the GDP, and the revenue deficit should be below 0.5% of GDP. Receipts and expenditure. In 2022-23, 54% of the total receipts came from sources outside the control of the states. Devolution of central taxes, 21%, SGST revenue, 16%, central grants, 15%, and loans for capital outlay, 2%. Some portion of the central GST is also given to the states. Revenue from state GST, SGST, accounts for about 44% of states' own tax revenue. In 2023-24, SGST to GSDP ratio was 2.9%, average. Integrated GST is levied on interstate transactions and imports. IGST has contributed to almost half of the overall GST collection. IGST settlement formed around 46% of the total SGST revenue. Receipts and expenditure. States' own tax revenue sources includes SGST, 44%, sales tax/VAT, 21%, excise duty, 14%, stamp duty, 12%, taxes on vehicles and electricity, 10%. Sales tax is levied by states on petroleum products and alcohol. Excise duty is levied on alcohol. Andhra Pradesh, Delhi, Gujarat, Haryana, Karnataka, Kerala, Maharashtra, Punjab, Tamil Nadu, and Telangana are estimated to raise over 50% of their revenue receipts through own tax revenue. Bihar, Jammu and Kashmir, and northeastern states are estimated to raise more than 60% of their revenue from devolution and grants from the center. In 2024-25, on the average, states spent 52% of their expenditure on salaries, 27%, pension, 13%, and interest, 12%. Himachal Pradesh, Punjab, and Kerala had a committed expenditure above 70% of their revenue receipts. Total revenue, crores. Maharashtra, Uttar Pradesh, Karnataka, Tamil Nadu, and Telangana had the highest total revenue. Non-tax revenue includes dividends and profits from government organizations, mining royalties, traffic fines, tuition fees, water charges, excise duty, etc. Odisha had the highest non-tax revenue, mostly from mining royalties, not shown this chart. Revenue deficit in crores. Tamil Nadu, Andhra Pradesh, West Bengal, Kerala, and Karnataka had the highest revenue deficit. Of these states with a high revenue deficit, Karnataka, Kerala, and Tamil Nadu had a per capita income in the top 7 among states in UT. West Bengal had a per capita income in the bottom 7 among states in UT. 12 states and union territories showed a revenue deficit. Uttar Pradesh, Odisha, and Jharkhand had the highest revenue surplus. However, these states had a low per capita income.
Revenue deficit as percentage of GSDP. As a percentage of the GSDP, Punjab 2.9%, Andhra Pradesh 2.1%, Kerala 2.1%, Himachal Pradesh 2.0%, and Tamil Nadu 1.9% had the highest revenue deficit. Among the larger states, J&K 6.5%, Jharkhand 4%, UP 3%, Odisha 3.0%, and Gujarat 1.5% had a revenue surplus. The Government of India recommends a revenue deficit that is no more than 0.5% of the GSDP. A revenue surplus does not imply a higher per capita income or better social and health metrics. UP has the highest revenue surplus but the second lowest per capita income in India. Odisha had the second highest revenue surplus but the highest maternal mortality in India.
Fiscal deficit in crores. Fiscal deficit is the excess of government expenditure over its receipts. Maharashtra, Tamil Nadu, Uttar Pradesh, and Karnataka had the highest fiscal deficit. These states also have the highest GSDP among all the states and union territories. The lowest fiscal deficit was for union territories and smaller states such as Puducherry, Mizoram, Nagaland, and Manipur. Northeastern states have a lower fiscal deficit because they have lesser capital expenditure compared to the bigger states. Fiscal deficit as percentage of GSDP. The fiscal deficit gap is filled by borrowings. A higher fiscal deficit indicates a higher borrowing requirement in a financial year. The 15th Finance Commission has recommended that the fiscal deficit be no more than 3% of the GSDP. Several states have budgeted a fiscal deficit above 3.2% for 2024-25. States with the highest fiscal deficit are Himachal Pradesh, Sikkim 5.4%, Andhra Pradesh 4.2%, Madhya Pradesh 4.1%, and Rajasthan 3.9%. Outstanding liabilities as percentage of GSDP. Outstanding liabilities is the debt accumulated by states from borrowings in the past. High liabilities leads to higher interest payment by states. The FRBM Review Committee recommended a limit of 20% of GDP on states' outstanding liabilities. On the average, the outstanding liabilities of the states is 27.6% of GSDP. 19 states have a liability greater than 30% of their GSDP. The highest liabilities are for Arunachal Pradesh, 50%, Punjab, 48%, Himachal Pradesh, 44%, Nagaland, 44%, and Meghalaya, 42%. States with the lowest liabilities are Karnataka, 23%, Odisha, 14%, Gujarat, 18%, Odisha, 14%, and Maharashtra, 19%. Maharashtra has a revenue deficit of 0.5%, a fiscal deficit of 2.6%, and a liability of 19% as a percentage of GSDP. It is the best managed state from a finance perspective. Interest payment. Tamil Nadu, Maharashtra, Uttar Pradesh, West Bengal, and Karnataka had the highest interest payment in 2024-25. These states also had the highest GSDP and NSDP. It is apparent that economic growth has come with deficit spending. As a percentage of the GSDP, only West Bengal at 4.53% is in the top 5. See next slide. Interest payment as percent of GSDP. Jammu and Kashmir, Punjab, Tripura, West Bengal, and Kerala had the highest interest payment as a percentage of their GSDP. Odisha, Maharashtra, Chhattisgarh, Gujarat, and Karnataka had the lowest interest payment as a percentage of their GSDP. Maharashtra, 1.94%, Karnataka, 2.67%, Uttar Pradesh, 3.22%, and Tamil Nadu, 3.38%, have low interest payments as a percentage of their GSDP, even though they are in the top 5 in absolute numbers, see previous slide. Budget estimates and actuals. States on an average raised 11% less revenue than their budget estimates between 2015-16 and 2022-23. States with the highest shortfall were Manipur, Andhra Pradesh, 21%, and Telangana, 21%. Karnataka was the only state which met its budget target in this period. Budget estimates and spending. States on average underspent their budget estimates by 10% between 2015-16 and 2022-23 due to shortfall in revenue collection. Manipur, 23%, Goa, 22%, and Tripura, 20%, had the highest underspending. Karnataka, Madhya Pradesh, Tamil Nadu, and West Bengal saw the least variance between budget figures and actual spending. Subsidies. States on average spent 9% of their revenue receipts on subsidies. States with the highest spending on subsidies were Punjab, 24%, Andhra Pradesh, 15%, Rajasthan, 13%, Gujarat, 13%, and Tamil Nadu, 12%. Subsidies are given for electricity, public distribution system, education, and health. 95% of the total subsidies in Punjab and Rajasthan were provided to the electricity sector. Sectoral spending on education. States on average spent 15% of their budget on education. The highest spenders on education were Delhi, 24.2%, Bihar, 21.4%, Rajasthan, 19.5%, and Himachal Pradesh, 18%. However, Bihar and Rajasthan had among the lowest literacy rates, and Bihar had among the lowest GER from Class 6 to Class 12. Kerala spends 13.3% on education, but its GER stays above 94% from Class 1 to 12. It has the highest literacy rate. It is apparent that spending heavily on education is not sufficient for better educational achievement. Sectoral spending on social welfare and nutrition. States on average spent 7.6% of their budget on social welfare and nutrition. The largest spenders were West Bengal, 14.7%, Karnataka, 13.2%, Odisha, 11.6%, and Madhya Pradesh, 10.5%. Karnataka's spending on social welfare estimated to more than double from 2022-23. Sectoral spending on health and family welfare. National health policy recommends 8% of budget allocation to health. Most states allocate less than 8%. The highest allocation was in Delhi, 13%, Puducherry, 9.5%, Odisha, 8.7%, and Goa, 8.4%. 3 of the top 4 are union territories. Goa and Puducherry had a multidimensional poverty index of 0. Delhi had an MPI of 0.01. Bihar spent 5.7% on health and family welfare. It had the highest MPI of 0.16. Tamil Nadu spends 5% on health and family welfare. It has an MPI of 0.01. As with education, a higher allocation for health does not always appear to correlate with a lower MPI for the bigger states.
Sectoral spending on roads and bridges. States will spend 4.3% of their budget on roads and bridges. The highest allocation was in Arunachal Pradesh, 12.3%, Odisha, 8%, Himachal Pradesh, 7.5%, and Meghalaya, 7.4%. 3 of the top 4 spenders are hill states.
Tax collection and devolution. Revenue flowing from the states to the center consists of direct taxes, income tax, corporate tax, indirect taxes, CGST, customs duty, central excise, education cess, agricultural cess, surcharges. Of these, the center shares a portion of the direct and indirect taxes with the states. The cesses are not shared with the states. The Finance Commission determines the percentage of the taxes that must be given to the states. Tax collection and devolution. The center gives 42% of the collected taxes to the states. The distribution is based on need and not on the state's contribution to tax and GST collection. Maharashtra, Delhi, and Karnataka contribute over 60% of the direct tax collected by the government. Mumbai, Delhi, and Bangalore have the headquarters of several companies with large revenues. Tax collected from these companies is attributed to these cities/state, even if the revenue is earned elsewhere in the country. These cities also have individuals with large net worth who contribute a significant percentage of the income tax collected by the center. Maharashtra, Karnataka, Gujarat, and Tamil Nadu generate the most GST income. However, none of these states get the most money from the center. Uttar Pradesh and Bihar get the most money from the devolution. For every rupee of tax that Maharashtra sends to the center, it gets 7 to 11 paise from the center. For every rupee of tax that Bihar sends to the center, it gets 7 to 9 rupees from the center. Tax collection. Mumbai is the financial capital and houses the headquarters of most large Indian corporations and banks such as SBI, Tata, Reliance, etc. Most of India's corporate tax is collected from Mumbai. Mumbai and Delhi have the largest number of high net worth individuals contributing significantly to direct income tax. GST data is often considered a better indicator of regional consumption and industrial output. Maharashtra, Karnataka, and Tamil Nadu are among the largest contributors to both direct taxes and total GST. Tax devolution. The Finance Commission uses the following metrics to determine how much each state gets from the tax pool. Income distance 45%, population 15%, area 15%, forest and ecology 10%, demographic performance 12.5%, and tax effort 2.5%. In 2024-25 BE, Uttar Pradesh 332,594.6 crores, 16%, Bihar 165,324.8 crores, 8%, Madhya Pradesh 148,540.5 crores, 7.2%, Maharashtra 136,614.6 crores, 6.6%, and West Bengal 134,988.5 crores, 6.5%, received the highest percentage of the tax devolution. Andhra Pradesh 97,471 crores, 4.7%, Tamil Nadu 86,724.3 crores, 4.2%, and Karnataka 64,528 crores, 3.1%, received less than 5% of the tax devolution. Tamil Nadu and Karnataka were the second and third highest contributors to India's GDP. Return on tax contribution to center. States such as Maharashtra, Karnataka, and Tamil Nadu that contribute the highest tax to the center and have the highest GSDP get the lowest allocation from the center. This is due to the high weightage given to income distance, 45%, difference between the per capita GSDP of a particular state and the per capita GSDP of the state with the highest per capita income, and population, 15%. Karnataka has the highest per capita income, Bihar has the lowest per capita income, and Uttar Pradesh has the highest population. Rural unemployment. Unemployment is calculated as a percentage of the labor force. Labor force is the working age population, 1559, which excludes homemakers, retired people, and students. States with a higher per capita income have a higher unemployment rate because of high expectations among the literate population. States like Chhattisgarh and Madhya Pradesh have an unemployment rate below 1% because the higher poverty makes it necessary to work even in low-paying jobs. A value of 3% means that for every 100 people, 3 people could not find employment even for a few hours a week. Urban unemployment. Urban unemployment is usually higher than rural unemployment. In rural areas, agriculture is the dominant employer. A few hours of work in the fields is considered as employment. In urban areas, a large percentage of the jobs are in the organized sector, such as factories, offices, companies, shops, etc., which can see a downturn and job losses. People might wait to get a matching job rather than taking any job. Per capita power, availability. Goa, 3,417 kilowatt hours, Punjab, 2,503 kilowatt hours, Telangana, 2,306 kilowatt hours, and Haryana, 2,294 kilowatt hours had the highest per capita availability of power. Manipur, 329 kilowatt hours, Bihar, 344 kilowatt hours, Assam, 356 kilowatt hours, and Jharkhand, 379 kilowatt hours, had the lowest power availability. Note 1. Punjab provides 100% subsidized power to the agricultural sector. In 2024-25, the power subsidy bill for Punjab is estimated to be around 20,000 crore rupees, which is over 90% of the total subsidies. It had the 7th highest revenue deficit in India of 23,198 crore rupees. See slide 14. Note 2. Bihar, Jharkhand, and Assam were in the bottom 8 in per capita income. Railways and roadways. Uttar Pradesh, Rajasthan, and Madhya Pradesh had the longest railway network in India. Maharashtra, Uttar Pradesh, and Rajasthan had the longest national highways in India. A longer road and rail network enables the quick transportation of people and goods within and across states. This and the following slides will summarize the data. Per capita income. In 2024-25, using constant prices base year 2011-2012, Karnataka and Tamil Nadu had a per capita income of rupees 204,605 and rupees 197,747. Bihar and UP had a per capita income was rupees 36,342 and rupees 55,990. The ratio between the per capita incomes of Karnataka and Bihar has increased from 4.15 times in 2011-2012 to 6.3 times in 2024-25. Income distance has increased. Similarly, the ratio between the per capita incomes of Tamil Nadu and Uttar Pradesh has increased from 2.85 to 3.53 between 2011-2012 and 2024-25. Income distance has increased. Surplus and deficit. A state's revenue surplus does not appear to result in good economic and health indicators for the residents of the state. UP, Odisha, and Jharkhand had a revenue surplus in 2024-25 BE. UP had the second lowest per capita income among states, and Odisha had the highest maternal mortality. UP and Jharkhand had low literacy rates. Karnataka, Tamil Nadu, and Kerala had a revenue deficit, but their per capita income was among the top 5 among states. Spending heavily on education does not guarantee better educational achievement. Bihar allocated 21.4% and Rajasthan allocated 19.5% of their budget on education. Bihar and Rajasthan had among the lowest literacy rates, and Bihar had among the lowest GER from Class 6 to Class 12. Kerala and Tamil Nadu spent 13.3% and 13.7% of their budget on education. Kerala and Tamil Nadu had high literacy rates and a gross enrollment ratio above 75% at the higher secondary school level. Surplus and deficit. Revenue deficit, fiscal deficit, and high interest payments does not imply poor fiscal management. Maharashtra, Tamil Nadu, Uttar Pradesh, and Karnataka had the highest fiscal deficit.
Maharashtra, Tamil Nadu, and Karnataka were among the top 5 in per capita income among states. Tamil Nadu, Maharashtra, Uttar Pradesh, West Bengal, and Karnataka had the highest interest payment in 2024-25. As a percentage of their GSDP, interest payments were low. Maharashtra, 1.94%, Karnataka, 2.67%, Uttar Pradesh, 3.22%, and Tamil Nadu, 3.38%. The primary reason for the slower growth in states like Bihar, Uttar Pradesh, and Madhya Pradesh is the growth in population. Between 2012 and 2025, Bihar's population grew by 24.4%, from 10.6 crores to 13.19 crores, estimate, an annual growth rate of 1.7%. Uttar Pradesh's population grew by 18.8%, from 20.35 crores to 24.18 crores, estimate, an annual growth of 1.33%. This means UP's population grew by about 27 lakhs every year between 2012 and 2025. Tamil Nadu's population grew by 5.6%, from 7.31 crores to 7.72 crores, estimate, an annual growth of 0.42%. Tamil Nadu's population grew by about 3 lakhs per year between 2012 and 2025.
For devolution of taxes, the Finance Commission assigns a 45% weightage to income distance and 15% weightage to population. States like Bihar, UP, Madhya Pradesh, with low per capita income and high population, have benefited from this weightage. For the same reasons, states like Tamil Nadu and Karnataka receive a much smaller percentage of the devolution. However, Bihar, Uttar Pradesh, and Madhya Pradesh had the lowest per capita income in 2011-12 and 2024-25. These states have among the lowest GER at the secondary and higher secondary school levels. They had higher multidimensional poverty index, MPI, compared to states like Kerala and Tamil Nadu.
There is scope for change, starting with devolution. It appears that the current weightage has not helped the states which require the most help. Weightage must be assigned to factors that will help improve the quality of life, especially in poorer states like Bihar and UP. To help the lower per capita income states, the Finance Commission could increase the weightage for demographic performance and decrease the weightage for population. This will motivate states to aim for lower population growth. Create a new criteria to increase the GER in schools and colleges. Higher educational achievement will reduce population growth rate, open up job opportunities, and reduce the migration of talented youth to other states in search of jobs. Encourage focused spending to help states reduce their multidimensional poverty index. States must spend an agreed-upon percentage of the amount sent by the center to improve nutrition, provide access to drinking water and sanitation, provide access to prenatal, neonatal, and postnatal care, which will reduce infant and maternal mortality. Vocational training. Pradhan Mantri Kaushal Vikas Yojana 4.0 emphasizes on-job training, OJT. This is a short-term certification program that does not appear to provide deep hands-on knowledge. About 15 to 20% have secured employment. The Pradhan Mantri National Apprenticeship Promotion Scheme, PMNAPS, provides apprenticeship with stipends and on-job training, OJT. This has a higher employment rate of about 60%. Enrollment, completion, and employment in these schemes could be another criteria that can be used by the Finance Commission when it determines the amount to be devolved to the states. In general, the weightage determined by the Finance Commission does not reward better performing states, nor does it help the poorer states. It does not incentivize states to improve the social, health, and economic well-being of its citizens. Human Development Index, HDI. The HDI is an index that is used to measure a country's development by the United Nations Development Program. It uses 3 criteria: life expectancy at birth, mean years of schooling and expected years of schooling, and the gross national income per capita, purchasing power parity. The HDI uses the logarithm of income to reflect the diminishing importance of income with increasing GNI. The index ranges from 0 to 1. In 2023-24, India's HDI was 0.68, placing it in the medium development category. States like Kerala, Maharashtra, Tamil Nadu, and Karnataka have an HDI above 0.7, placing them in the high development category. Due to lower per capita income, life expectancy, and GER, Bihar has an HDI of about 0.58, UP has an HDI of about 0.6, and Madhya Pradesh has an HDI of about 0.61. While per capita income of India has increased by an average of 60% since 2011, the HDI has increased by only 11% in the same period, indicating that improving health and educational metrics is more difficult than raising per capita income.